and only Monty Greenspan. Now, Monty he was the former senior market analyst at eToro, and he has now branched out and created his own business called Quantum Economics. And his newsletter is straight fire. Like, he's got a 40% open rate on his newsletter. You know that? You know how good your newsletter has to be to get a 40% open rate?
It's one of the few that I read. I mean, honestly, and I'm not just blowing smoke here. I read Monty's newsletter.
Because you don't normally read words too much.
I don't, words confuse me. Let's bring him in here. Monty Greenspan. He's going to talk about how markets have been affected by the pandemic and how to invest in a post-virus world. Monty Greenspan, welcome to Virtual Blockchain Week, friend.
What's up, guys?
How you doing?
How's the weather over there?
Beautiful in Denver. The sun's starting to go down. Travis, is it nice in Kansas City?
Not too shabby at all. And where are you located in the world, Mr. Greenspan?
I'm here in Tel Aviv. It's about 10 minutes to 4 in the morning.
Ooh.
My son decided he's not missing Daddy's speech today.
Oh, very nice.
Can I just say that is commitment? Like the fact that you are here for this now, that is commitment, my friend.
In a bow tie. Dude, that's some swag, brother.
In Botox? Oh, no, bow tie.
Look at his bow tie.
Botox.
So, Monty, do you have slides that you want to present?
I do. Let me pull up my...
We're gonna turn it over to you as soon as you're ready and let you take it away and educate us, because we need to learn things that you have to say.
All right. I'll do my best not to disappoint.
Yeah, and
he's going to do his best to remain quiet throughout the presentation, right?
You want some snacks, Dad?
All right, Monty, do your thing.
All right. Hi, everybody. My name is Monty Greenspan. I am the founder of Quantum Economics, which is a firm for analysis, advisory, and money management. We'll speak a bit more about that before, but for myself, I'm the former senior market analyst in eToro, if you're familiar with eToro. I'm a licensed portfolio manager in the European Union, and have co-authored a book called The Complete Guide to FinTech Investing. So that's me in a nutshell. And today we're going to speak about COVID-19's impact on the financial markets. And hopefully we'll do our best to make sure, because obviously we're all living this, but I'll do my best to see how, show you how it looks from the market perspective, and maybe you get a few ideas for investing and trading through it. The way that I like to look at it is basically like a car, and imagine a car is driving along extremely fast, maybe 120 miles an hour, maybe a bit more. Actually, it's the fastest car that has ever happened. We're coming off of a 13-year bull run in the stock markets, which is probably one of the longest in history, thanks in large part to ample help from, the government and the central banks and the Federal Reserve. I'm going to try and focus on just America, because I know that probably everybody else is sleeping, and most likely most of you watching today are in America. And I think that actually that's where one of the biggest impacts have been is the United States. Obviously, probably you guys are aware that the most cases by far of COVID-19 are over there. If you look at the right-hand side of this slide, you'll see a headline from the New York Times. I do believe that this front page article is going to be one of the defining media moments of this crisis. Because on the bottom, there's a yellow graph which shows the unemployment. This is basically how many people filed for unemployment each week. In the middle of the graph is a shaded area. That's the 2008 financial crisis. And then on the right side, there's that giant line that goes all the way up the page. And this is basically just the first week of COVID-19. 3.3 million people filed for unemployment, which was more than it ever done by far in history, something around 5 times more. The week after that, this number doubled to 6.6 million, and then another 6.6 million the week later. This week we're good with about 4.5 million. We'll see what happens next week. So obviously the unemployment, I think, is the biggest defining factor of this. It's basically all of a sudden people are out of work. On the upper left is the unemployment rate, which is the percentage of people who are able to be employed and what percentage of them are unemployed. And we can see that the economy was doing so good going into this that it was actually on a 50-year low. The unemployment rate had not been that low since about 1960, 1970. Maybe a bit before that. And you can see that little tiny blue part at the top, that's just trying to reflect the very early part of COVID-19. But when this statistic is reported next month, it's expected to jump to the highest ever. So somewhere in the tune of 12%, 13%. Some have estimated 20%, but most likely the largest ever. And probably around 200 million people have lost their jobs around the world. The first thing that we can see, the first impact that took place in the financial markets was a great search of liquidity. Because economies, they don't go up and down like most people think. They actually expand and contract. You think of it kind of as a helium balloon, and over time it expands like this. And when the Fed prints money, that goes into the balloon, makes the balloon bigger and bigger and bigger and bigger. And then when there's a contraction, it comes in. But when there's a catalyst like this, and a lot of the time people say you need a catalyst, right, to set off a market crash, or you need a catalyst to turn things around. And this is, COVID-19. I mean, that's one fuckload of a catalyst. I mean, we've never had a catalyst like that in the history of the world, really, where all of a sudden everything around the world stops. I mean, there were maybe 2 or 3 pandemics in the last 1,000 years of this nature. So what happened was that shock just went like that. And during that phase of everything contracting all at once, very fast, all assets go down, and that includes stocks and bonds and real estate and anything that you can think of that value, commodities and currencies. But when you think about it, when people are selling a stock, or when they're selling a bond, or they're selling their property, or whatever else they're selling, they have to put that value is going to go somewhere. Most of the time, most of the value is going to dissipate because the balloon is now smaller. But what they're doing actually is they're buying the currency, right? When you're selling a stock, you're actually buying the currency. So basically the US dollar saw its biggest crunch in history, where everybody was buying dollars all at once. But we could also view that as people dumping dollar-denominated assets, dollar-denominated debt, for example. The Federal Reserve actually had to go in at one point and say, okay, everybody who's holding US bonds, you can now just switch them for dollars without actually going to the market. We'll just give you dollars in place of the bonds that you're holding. That's never really happened before, but what they were trying to do is trying to stop the fire sale on US bonds, but rather just let people take dollars instead as a redemption method. I'm going to get a little bit complicated on you, but most of you, I think, should be a little bit familiar with this. So now we're talking about the response from the authorities, and there's 2 different authorities that are in charge of the money. The first one is the US Treasury, and they're providing ample fiscal stimulus. And you can see that in the numbers here. This is the US national debt. On the top left, 24 trillion was reached on April 9th. This screenshot is about a week old. Today we're at about 24.6 trillion. They're injecting about $40 billion per day into the US economy. So that's all fiscal stimulus. On the bottom is the central bank, which is the Federal Reserve. And you can see that spike on the right-hand side, that is basically the response to this crisis, which is it's already doubled what the response in 2008. Actually, if you take from September 2008, I don't know if you can see my cursor, all the way to around 2013, that's about the size. So about what they've printed in 5 years. In the last crisis, they've now printed in 2 months. And that's all under monetary stimulus. So you have fiscal stimulus and monetary stimulus. And what they're trying to do here is they're trying to build a bridge, right? They're saying, okay, the economy, we're going to stop the economy for a bit, but what we're going to do is we're going to hold it up ourselves. The government and the central bank, we're actually going to be able to hold up the economy so that when we get onto the other end of this, people can go back to work and we can have a complete bounce back. And that's what they're hoping for. Now, obviously, an experiment like this has never happened. And the success of the experiment is largely going to depend on the virus. I mean, if the virus goes away relatively quickly, we might get out of this with very little damage. But the longer and every single day that this goes on, they have to extend that bridge more and more and more and more. And obviously those dollar signs that you're seeing in the middle, they're not going to be able to hold up things forever, because at the end of the day, more money in the system equals more debt. And we're just basically rolling that forward and pushing it to a future generation. One of my biggest concerns, we'll talk about in a moment, is what kind of effects that can have long-term on the economy. But I also just wanted to touch on crude oil, very important, because this has been a hallmark of this crisis. We have Mohammed bin Salman, the king of Saudi Arabia, on the left, Vladimir Putin on the right, and basically very early on in the crisis. So what happened to crude oil is basically the demand stopped, right? Nobody's flying anymore, so no jet fuel. Nobody's driving anymore, so no gasoline. Nobody needs oil whatsoever. But instead of going on lockdown like the rest of us, they continued to pump oil. Everybody across the world, United States included, and everybody who's producing oil just kept the pumps going. And at the moment, they're reaching capacity on storage. There's nowhere to actually put the oil. An unlikely savior came in, Donald Trump, who came in and said, okay, get this sorted out. And they came through and they put together a historic deal. I don't remember what the final number was, but they basically, both of them decided to cut production on a historic level. However, it really wasn't enough because there's no demand. They should actually just stop all of the production, but instead they continued to pump, and that's how we saw negative oil earlier this month. And I believe that it's very possible that we'll be seeing negative oil once again before too long, because people talk about the contracts and the way the oil is traded. It doesn't matter. Actually, what's happening is there's just no place to put it, and where you see that is on the front contract, on the closest contract, and that's where the pain point is, because people need to get rid of this oil right now, and people think that maybe it'll be worth $30 in a year and a half from now, and it might, but that really depends on the virus and how soon we come back to things. And of course, since we are on virtual blockchain week, I cannot leave this presentation without talking about crypto assets. But unfortunately, I think that most of you are not going to like what I have to say, that crypto is the least of the hallmarks of this so far. Nothing has emerged that says, okay, crypto is going to be our savior. In fact, what crypto did is actually kind of what I was expecting a year ago. And I was on the stage in Amsterdam, and somebody asked me, so what happens to Bitcoin if there's a crisis? And my immediate thought was it goes down, because people need to cash out in order to respond to the crisis. And that's from private citizens who might need to feed their families to portfolio managers who might need that money to sustain their portfolios. And this graph, I think that one in the middle, is a defining moment for crypto, or I think this is the graph that shows what's happening in crypto, is the correlation between Bitcoin and the S&P 500, so the US stock market. And this is measured, the graph comes from coinmetrics.io, and it's measured between -1 and 1, where 1 is a perfect correlation, means that if the stocks go up 1%, Bitcoin goes up 1% that day, and -1 is a perfect reverse correlation. So if the stocks go up 1%, Bitcoin goes down 1%. 0 means absolutely no correlation. And as you can see, we've spiked up to the highest ever. 0.3 means almost no correlation, right? So it's something that we could say there's just barely nothing. 0.6 is where we reached during this crisis, and I think that that's Sorry, I got a chat here. I'm not sure what this is about. In any case, yeah, sorry, Joel,
Beauty
go
of
on.
live, right?
Yeah.
By the way, you're father of the year. I mean, I'm watching you do this presentation. This is highly technical and, you know, heady stuff. And you're like feeding Fritos or something to your daughter. I don't
Bamba, the
There you
Israeli
go.
baby snack.
Here, I'll let you finish. Go ahead, Monty.
So yeah, and we do believe, and so during the initial impact, that makes sense because Bitcoin is a risk asset. Because it's a new technology, it hasn't achieved the safe haven status that gold has taken thousands of years to build up. It's we're talking about an 11-year-old asset, so we do need to see that as an emerging asset and something that's very risky. And so it followed the stocks almost to a T. And I believe that we can see that on the next slide. So this is actually all of the assets I think that I've been watching most closely throughout this crisis since the beginning of the crisis. And I'm going to count the beginning of the crisis as February 24th, which is the day that we saw headlines that COVID-19 was showing up in Iran and Italy, basically outside of China. And people, until then, for some reason, I was screaming in my newsletter every day, guys, there's something going to happen. There's a virus over here. It's not going to stay in China. But for some reason, the world was in a euphoria that it was going to stay in China. I don't understand why they thought it wasn't going to cross the border. But it did on February 24th, and this is what happened. Yellow is gold. And gold has had moments where it was definitely down during this crisis, especially when everything was selling off. Gold was selling off as well. Green is the US dollar, which we spoke about, and I think it was up about 5% at the peak, which was around March 20th when everybody was rushing to US dollars. But keep in mind, up 5% doesn't necessarily mean that the dollar had gained value 5%, but only that everything else went down in relation by that amount. So the dollar actually did lose value, but you have to measure it against something. So when you measure it against a basket of other currencies, it was actually up 5%. Blue is the stock market, the S&P 500, and white is silver. And I think that it's most interesting to point out that silver and the US stock market, the blue and the white line, are more correlated than just about everything else. Purple is Bitcoin, purple is crude oil, oh my gosh. Purple is crude oil, which we saw go down past that 100% level. This chart doesn't show it for some reason, now down about 67.5% since the beginning of the crisis. And orange, of course, is Bitcoin, which has been one of the best performers over, since the beginning of April. But if we're looking, and actually, if you look at it from the beginning of the year, Bitcoin is up probably to the tune of about 7% since January 1st. So not doing too bad, but of course there was a huge rally before that, which wiped things out. But also the stock market's not doing too bad. It's about 16% under. At this point, we're looking at the light at the end of the tunnel. Italy has already eased some restrictions. Where I am here in Israel, we've eased some restrictions. I know that in New York, where it's been the most painful, it's going to probably be about another 2 weeks before they start opening things back up. But some states in the United States are already on that track, and around the world, people are going, okay, we can open back up. But obviously, this is with extreme caution because we'll have to check. It's going to take us about 2 weeks on each stage, right? You need to open stuff up and then check 2-3 weeks. Are the infections coming back? So there needs to be a lot of testing to see where there's infections and everything like that. What's up, Joel? Are we out of time?
What? I thought you were wrapping. Sound like the light at the end of the tunnel might have been the end. So
that's it. So that's basically it. What my biggest concern is if there would be some sort of, because all that money that they're pushing in, once things come back online, if we'll go into a prolonged period of inflation. And if that happens, obviously your plays are Bitcoin, no duh, but also the stock markets tend to go up during inflation, but it'll depend which stocks. Property, on the other hand, is a whole world. I don't think that we'll have time to get into it, but of course, because of the working from home, it's going to be different types of properties are going to perform differently. That's about it for me. Come to the website. It's quantumeconomics.io. Sign up for the newsletter, because that is killer information that you're going to get in your inbox. But also, if you're new in the markets, you want to learn, you can learn to trade. We have a crypto trading masterclass. I also have put together already a team of analysts, and we are now writing materials such as ebooks, brochures, white papers, research papers, you name it. And many other things that you'll find on the website. There's really something for everybody there.
That's great.
Like
Thanks,
that.
Monty.
That was great. Bitcoin, duh.
Duh.
Bitcoin.com, quantumeconomics.io. You did well tooting your own horn, but you don't need to toot your own horn, because we'll toot it for you. Your newsletter is fantastic. It's down to earth. It's current, it's relevant, it's insightful. You can, sing and dance to it. It was better than Cats. I give it a 10.
That is the best review my newsletter has ever gotten.
There you go. Hey, thanks, Monty. We appreciate you.